The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line.
Awesome. Thank you so much. Welcome back to all those who have joined us for the last two sessions, and welcome to all of our new attendees to our virtual March Masterclass. This session is 2020 Vision, a view on regulatory changes, facilitated by our wonderful. Today's session will include a polling feature. The polling questions will pop up on your screen throughout the webinar. In order to receive your CPD, you must contribute to the discussion and choose your preferred answer to each question on your screen. If you would like a copy of the presentation, you can download this from the handout section in your right-hand side panel. And of course, if there is time at the end, we will do a short Q&A. However, in case that we do run out of time, we can get back to those unanswered queries personally. All right, Tara, I'll hand it over to you. Take it away.
Thank you, Jess, and thank you everyone for attending. As the title suggests, this presentation is designed to give you insight into what regulatory changes we expect to occur in 2020. I originally wrote this presentation not long after Treasury released draft legislation covering 22 Royal Commission recommendations. At that time, we knew that the year was going to be a tough one in terms of change. So we put together a team, a dedicated team at Centrepoint Alliance to do deep dives into each draft legislation to ensure we were across what changes were required. But then COVID-19 took hold. Now we see that the implementation of these draft legislations may be delayed. It is very uncertain, but we know through uncertain times you must prepare. So we're continuing to prepare in line with what the draft legislation is saying, but we know that it may be delayed in its implementation date. What we want to do is make sure that we are ready, and we're ready to support you, the advisors, and also the licensees on the line. Here's my disclaimer. This disclaimer just basically states it's presented here on behalf of Centrepoint Alliance to our network of advisors and licensees. It's based on our knowledge of the regulations and the laws at the present date, and it's not to be distributed to other people outside of the Centrepoint network or those guests that are joining us for the first time today. So the learning outcomes for this presentation is basically two parts. The first part is understanding the COVID-19 responses from the various regulators, and you've heard a little bit of that this morning from Peter Kelly and Mark Teal, or this afternoon. And the other part is understanding the impacts of the Royal Commission recommendations. So this is really focused on those draft legislations that came out in late January. And then there's a case study at the end of understanding how those draft legislations may actually impact on revenue. So COVID-19 responses, the first one I'll look at is what's ASIC's response to COVID-19. In a recent media release, ASIC came out and basically told us that they're going to focus all their regulatory efforts on the COVID-19 pandemic and responses to assist people with that. at least until 30 September 2020. Their priorities will include only those matters that have a significant risk to consumer harm, serious breaches of the law, risks to market integrity, and other time-critical matters relating to COVID-19 pandemic and other time-critical matters. What they've told us is they're suspending their near-term consultations and regulatory reports and reviews, and these include, and they've highlighted these in the media release, which is the review into the executive remuneration, internal dispute resolution guidance that was due to come out, and managed discretionary accounts as well. So they're all being placed on hold. The other thing they've placed on hold is they've suspended all their on-site supervisory work. This relates to the on-site work they're doing with the banks, so that's been placed on hold as well. They have released some guidance in relation to the ability for payment plans and fee waivers. If you have any issues, or you know your clients have issues with ASIC, you can actually go to them and request payment plans or fee waivers. And we would highly encourage you to have a look at their COVID-19 consumer page on MoneySmart. It gives some really good guidance to clients on what they can do and how they can support themselves through this change. The next regulator I'm going to look at is the Australian Tax Office. I'm not going to go into detail because the Australian Tax Office has got a huge page, a dedicated support page, and frequently asked questions all across COVID-19 and the changes that are going on there. Peter Kelly and Mark Teal did a great job this earlier talking about the stimulus package and various other support packages that are available to consumers and to businesses alike. I would encourage you to have a look at the ATO page. There are some additional measures that they've put out there. There's some good guidance on people working from home and how they can claim their expenses if they're purchasing equipment for working from home. And there's also some guidance around SMSFs. In particular, I saw that they have allow the ability to temporarily reduce rent for tenants, even where they're a related party, without fear of ATO action. So they've enabled that so they can actually reduce the rent to enable people to continue to, I suppose, survive through this time. And there's also some guidance where in-house assets may be more than 5%. They're provided some information about the ability to prepare a written plan that you can implement before 30 June 2021, so until next year. So, and that they won't take any action if you do not implement the plan due to various matters related to COVID-19. So that's actually a well worth reading section of the ATO website. AUSTRAC has also come out. AUSTRAC have said for any of the licensees on the line, they licensees would normally do their compliance reports and lodge them by the end of March. They've said that they're going to accept those compliance reports until 30 June this year without any risk of compliance action. And the other one is the Office of the Australian Privacy Commissioner, the OAIC. Not too much has come out here, but basically it's just a reminder, and there's some good guidance in there around the requirement to only disclose sensitive health information regarding COVID-19 on a need-to-know basis. So to the relevant authorities, to your building managers and the like. You should be taking measures to make sure that you're not disclosing anyone that may have, been in contact with someone with COVID-19 or that they have actually contracted the virus. That shouldn't be openly distributed to anyone other than those that actually need to know. So have a look at that if you're interested, if you have been affected by COVID-19 and you're making sure that you want to keep the private information both private and confidential. The other one is the Tax Practitioners Board. Many of you would have seen this come out. There was a release in their newsletter, and also I believe that most financial advisors or registered tax agents would have received notification around the waiver for the requirement to do their annual declaration. So if your annual declaration was due this year before 31 December 2020, you don't need to complete that until 2021. And I know that many of you will just have your registration renewals due next year. So that means you probably won't have to complete an annual declaration until 2022. The one thing that they did mention is that you do still need to continue to meet your other obligations around professional indemnity insurance, the fit and proper requirements, and personal tax obligations. So just because you don't need to complete the annual declaration doesn't mean you shouldn't lodge all your relevant tax returns or your BAS statements and the like. They have also announced that they've removed the CPE professional reading cap. So if you're looking for your tax points, your CPE in relation to tax, you can actually you can go past the normal 25% on that professional reading cap. FASIA or FASIA, whichever way you like to say it, they have moved towards a remote online option for their April exam. So for anyone that was actually registered for that exam, you can actually continue with that and do it remotely. And I'd assume that they'll continue to do remote options while the COVID-19 crisis is continuing. They have also released guidance in relation to CPD, the professional development points. They have clarified that video conferencing and or webinar technology are appropriate options, which is great because that's how we're doing it here. And they haven't provided any sort of leniency in relation to their education points though at the moment. The question that we're probably all asking is, do existing advisors still need to complete the exam prior to 1 January 2021? Now, they haven't come out. This is actually was put towards government, but as we know, Parliament isn't going to be sitting until August now, so we can't receive any sort of clarity around the exam. At the moment, if you go to the FASIA website, it will say that you do need to complete the exam by 1 January. However, they are pushing for a 12-month extension. We have received notification that, or received assurances that the government and the opposition will support the extension, but again, it hasn't been passed. So you need to still keep an eye on this space. We still encourage you to continue to complete your exam so that you do pass it and have got adequate time to pass it before any deadlines, but we're hoping that that will be pushed out for 12 months. If you have any questions about FASIA exams, please definitely go to our education team who are across all of that. So the second part of the presentation is about the Royal Commission and the Royal Commission update in relation to what legislation has passed, what's in draft legislation, and how is it going to impact on licensees and advisors. As we know, there were 76 recommendations in the final report of the Royal Commission. The government has already implemented 16 commitments. Some of these are relevant to those on the line is removal of grandfather conflicted remuneration. That's already passed. And in place, as we know, best interest duty for mortgage brokers, that starts as of July this year, and funeral expenses, the funeral expense insurance now requires an AFSL, and that actually commenced today. Draft legislation, as I said earlier in the presentation, was released in late January, so the 31st of January, and it was to implement 22 recommendations from the Royal Commission. All the consultations are now closed, and now that's back with Treasury and the government to actually decide upon. The key recommendations that I'll be speaking about today is disclosure of lack of independence, breach reporting changes, industry reference checking, advice fees from My Super and Choice accounts, and annual fee arrangements. And as I said before, Parliament is not expected to sit until August 2020 now, so we're sort of a little bit in limbo as to when these draft legislations will be implemented and whether the implementation dates will change. As I go through, you'll see that there are a number that are due to start in July, which we think is highly unlikely now to be pushed through. So they may be delayed or pushed out, but we do expect that the draft legislation will come into force at some stage, so we need to be ready and prepared. A lot of the industry have already made submissions on these draft legislations and the consultations that are open. AFA, FPA and various industry bodies have submitted. So hopefully we can see some changes to some of them. Some may not have as many changes as others, but as we go through the presentation, you'll see what I'm talking about. So First one I'll speak to you about is disclosure of non-independence. So this is proposed to commence on 1 July 2020, according to the draft legislation. Now, that is probably unlikely, as I said, because the Parliament needs to sit to pass it. But however, we can still look at what it is and how to prepare for it. So what it actually states is that you must provide written disclosure around the lack of independence before you provide personal advice to a client. As a refresher, just to remind everyone who can use the term independent, providing entities cannot be independent unless the advisor, the licensee, and any related parties of the licensee or the advisor do not receive commissions unless rebated in full, so that's insurance and trail commissions, that they do not receive volume-based payments from product issuers, so like volume bonuses, rebates on platforms and the like. What they have clarified is that asset-based advice fees are allowed. So because they're linked to advice, they're not just a payment from the product issuer, it's just a way of receiving the advice fee. You can't call yourself independent if you receive gifts or benefits from product issuers which may reasonably be expected to influence the advice. So be aware of that. You need to operate free from restrictions relating to financial products. So this would be where you can only write a certain product. You're very much restricted to an APL. APLs that have the ability to, provide approvals outside the APL would be allowable in this case. And you need to be free from conflicts of interest that arise from any relationship with product issuers. So for an example there would be licensees with white label products or licensees that actually own products. So any of those, you can't call yourself independent, and therefore you need to include a written statement about why you are not independent. And consultation paper 329 that ASIC released states that that should be in the financial services guide. And it's a pretty simple consultation paper in relation to this. It's just basically that you need to provide the statement about why you're not independent. It needs to be in the FSG on the first substantive page. It needs to appear within a box under a bold heading called not independent. I'm not quite sure why it needs to be in a box, but that is the recommendation. The font size needs to be at least the same font size as is predominantly used throughout the document, and it must not appear in a footnote. So that should be quite simple to implement. It's just coming up with the wording around why you're not independent so that it doesn't scare clients into thinking that you're not acting in their best interest. So our guidance here is that even though the commencement date of 1 July is most likely going to be delayed, that licensees should prepare the wording for their FSG so that when it is passed by Parliament, you can actually implement on time. So with that, I'll move to our first polling question, Jess. And the polling is open. So the question is very simple. If you receive asset-based advice fees, can you call yourself independent? And the answers are either A, yes, B, no, C, it depends, or D, only if you are a sole operator. And I'll just wait till they're finished. You let me know, Jess, and you can share the answers, the results.
Yep, those are the results there, Tar.
Okay, sorry, I can't actually see them. Okay, I can do it now. Sorry, I'm just learning this technology. Okay, so 42% of you said yes, which is good. You're listening. 28% said no, and 29% said it depends. So A and C is correct. So if that was the only thing that caused a conflict, you could call yourself independent. So if you are a licensee that had no relationship with products, you didn't receive any insurance commissions, you didn't receive any sort of rebates from product providers, you didn't receive gifts that could influence your advice, and the only thing was that you charge asset-based fees, you could call yourself independent. However, C is probably more likely correct because it depends, is that a lot of the time, even though as an advisor you may receive asset-based fees and that's the only thing that you believe could potentially influence your advice. The licensee itself may have associations with products. It may still receive trailing commission. It may receive insurance commission and the like. So yes, the answer is it depends. Okay, we'll keep moving on. The next draft legislation that came out is breach reporting. This one is a little bit later to be commenced. So this is proposed to commence as of 1 April next year, so 2021. However, this is the one with the greatest scrutiny from the industry. There is a lot of changes for licensees to consider. So the high level is, and I'm only going to do high level today because this one is pretty large. Basically, it introduces breach reporting for credit licenses. It has expanded the definition of reportable breaches, and it will include investigations into potential breaches as well. So you'd need to notify ASIC of those. The definition of significant has become less subjective. Many advisors on the line might not know how we define whether a breach is significant or not, but basically the current wording is that if there is significant client loss or detriment, or there's significant loss or detriment to the license, or it indicates that the license has an inability to manage the license, that would be something that would have to report as a significant breach. Now, what they've actually come out with in this draft legislation is a number of different definitions. Basically, any breach of the Corporations Act or relevant financial planning laws where there's a criminal penalty of imprisonment of more than 3 months, or 12 months for things that aren't dishonest. It also, the biggest one is that it includes any breach of a part of the Corps Act that has a civil penalty attached. And this is really important because there's a lot of parts of the Corps Act where a civil penalty is implicated, but it doesn't actually pose a major risk of harm to a client or detriment. So for example, it could be as simple as you didn't provide an FSG to the client prior to providing personal advice. That could be a breach under this new definition of significant, and would need to be notified to ASIC. The same is that they don't actually have any sort of leveling with it. So if you didn't do an FDS on time, you gave it 2 days late, that would be a breach of the Corporations Act that has a civil penalty attached, and you'd need to notify ASIC. So this is something that the industry bodies and the relevant licensees have actually gone back to the Treasury on and said that we don't believe that this is going to actually assist clients. You know, the idea is that we'd prevent harm or identify harm sooner. It's going to have a lot of minor, what they would currently consider minor breaches, that is going to cause an administration nightmare for licensees, and also then ASIC's going to see a lot of minor issues and not know what to focus their attention on. The other changes to breach reporting is that we've got 30 days to report breaches to ASIC. This is an increase from the current 10 business days, so that's probably an easier thing to implement. Another thing is that ASIC will publish breach data annually at the end of each financial year. That will be at a licensee level, so statistical information, but at the actual licensee or the group level. There is also a requirement to report other AFSLs and ACLs, and that's even suspected breaches. So if a licensee, if we see that another licensee is potentially breaching the law, then we need to actually report that to ASIC as well. And there's increased remediation requirements, particularly in relation to notifying clients at within particular dates and times. So that is something that is going to be another thing for licensees to manage through this breach reporting. The reminder, this is effective. Oh, sorry. I forgot what I wrote there. This, the last part here is for the licensees on the line as of the 30th of March. So right now, if you are doing any breach reports to ASIC, they will only accept them through the online portal now, not through emails, which I know many of you may have been doing in the past. Now you actually have to log in through the regulatory portal and lodge your breach online that way. The next draft legislation is industry reference checking, and I'll go through this one quite quickly. This is proposed to commence on the 1st of April 2021. Basically, it's just to come in line with the ABA protocol. So that's making sure that every licensee will actually do reference checking before they put any advisors or employees on board, and applies to ACLs and AFSLs, and actually forms part of the general obligations of the license. The other part is that you need to appoint a key contact person for reference checking. The commencement date now is probably postponed, but we need to just be prepared in relation to that. Advisories from Super as well, I'll run through this one quite quickly. It's proposed to commence 1st of July this year. Again, that's probably going to be delayed, but basically it was to that any fees, advice fees from MySuper products will be prohibited from the 1st of July 2020. Deductions of any advice fees other than intra-fund advice would need to comply with the annual fee arrangement requirements, so annual renewal and express written consent, and that would need to be for any new clients as of 1 July this year, and then any existing clients would need to get that consent by the 1 January 2021. As I said, that is now postponed, as potentially postponed, but maybe it could get passed through, so we'll just keep an eye on that one as well. Annual fee renewals. This is probably the most important one to look at. So this is proposed to commence as of 1 July 2020 as well, so this year. Again, we don't know where that's going to go. There is no change to the ongoing fee arrangement definition. So ongoing fees for a period of greater than 12 months is what they define as an ongoing fee arrangement. So any fees that are less than a period of 12 months do not apply. All ongoing fee arrangements, both pre and post FOFA, so your pre-2013 clients must be renewed annually. So they're all opting in now. So we don't have just FDS clients and some FDS opt-in. We have all FDS and opt-in ongoing fee clients. The FDS is slightly different to what they had before. The main difference is that you need to show each ongoing fee charged in the previous year and a reasonable estimate of each ongoing fee, including a methodology to be charged in the upcoming year. And it also needs to include the services entitled to and provided in the previous year and the services entitled to in the upcoming year. Advisors must provide copies of the client's written consent to the product provider to ensure that the fees continue. Disclosure days have been repealed and they're now replaced with the day the client signs the consent, not a fixed date. And no change to renewal period. So there's the 60 days to provide the FDS and the opt-in. 30 days is the renewal period for the client to agree to the renewal. And then fees need to be switched off a further 30 days after that if they don't renew or don't respond. That was a summary of it, but the complexity is probably a little bit more. So we've got 6-month transitional periods to start from 1 July to 31st of December 2020. And this is for your pre-FOFA client. So if you have a pre-FOFA client, the way the draft legislation stated is that you will need to get those clients an FDS with an opt-in and a written consent prior to the end of this year. So that's a lot of work to do for those which have got a lot of pre-FOFA clients. There is no clear obligation placed on the product providers, so it doesn't actually state that they've got an obligation to switch off fees if they don't receive the consent. They haven't added anything in particular about that. So the other concern we have is that there's potential for multiple consent forms and inconsistent processes across providers. They have come out with some guidance on what the consent form needs to include, so hopefully the providers will work together to have a similar process. There's no fixed disclosure date, so there is some potential for gaps and some difficult administration. I'll show you a slide soon on how that works. And where clients withdraw consent, you must provide written confirmation to the client within 5 business days and to the product provider. So a client says, no, I want to cancel my ongoing fee. You need to email that client back within 5 business days to say, yes, we've received that request and we're actioning that. And you need to do that to the product provider as well. So a lot more administration for you. And then where fees are received without consent, so if you continue to receive the fees after the consent should be withdrawn, these must be refunded within 5 business days. Now, this can be quite difficult to administer because it may take longer for the product providers to enact the request and the refund. You have to consider things like holidays and staffing requirements and the like as well. So that's going to be an extra requirement that advisors and licensees will have to keep an eye on. The consent form that ASIC have suggested needs to be used, needs to include all this information. So basically the name of the account holder, account name and number, name and contact details of the fee recipient, explanation of why the account holder's consent is being sought, services the client is entitled to receive, the frequency, amount and time of each payment, or a reasonable estimate. And they have included this wording, which is good for those who are charging asset-based fees. So it can be based on the current account balance in accordance with what ASIC has put forward. So this is an estimate only. It is based on the ongoing fees that you have paid in the previous year and your account balance at the time that we prepared the consent. It needs to include some warnings about that what the fees could cause. So things like loss of insurance or increase in admin fees due to low balances if the fees were to impact on the balance. Expiry date of the consent needs to be included and a statement that client can withdraw consent at any time. The good news is that ASIC have confirmed that this can be merged with your renewal notice. So hopefully we don't have to do an FDS, a renewal notice and a consent form. We can actually merge them a bit together, provided it includes all the information. I'm just going to run through this really quickly. I'm very conscious of time, but basically this is the new FDS renewal process. So this is an example. Clients, you send the FDS to the client on the 1st of September. It's for the FDS period 1st of September 2019 to the 31st of August 2021, because it's 2 years we're looking at now. The client signs a consent on the 20th of September, then you've got 12 months and then you've got 60 days. Then you need to send your next FDS. So in this case, you send it on the 1st of November. Again, you're looking at what was actually provided, so the actual fees, and then you're providing an estimate of fees for the next bit. The client gives the consent within the 30 days and you move to the next 12 months with 60 days, and then you may provide it then on the 10th of January 2023. Again, you've got an actual figure and an estimated figure, and then the client might not sign the consent, and then you need to turn the fees off. So it's something that's going to be quite difficult to track. It's very similar to what we've got at the moment, but the difference is that you have potentials for gaps here, and you've also got this issue of you've got an actual figure and an estimate, and will they vary from time to time? And I'm sure they will sometimes, and the client may actually say, well, last year you told me that it was going to be $1,500, but then it actually ended up being $2,200. Why is the difference? And then that's an extra thing that we'll have to explain to clients. The next polling question, if we open that up, Jess. Okay, polling question, based on draft legislation, when do you need to get your pre-FOFA clients to provide written consent? Is it A, 1st of July 2020, B, 31st of December 2020, C, 1st of July 2021, or D, they continue to be grandfathered? And I think we can probably close that, Jess. It looks like everyone's sort of...
Yeah, we've got about 60% voted, 70 now, so I'll close that one.
Yep.
And
So
just
yeah, so the answer there is B, the 31st of December 2020. So at the moment with the draft legislation, it is stating that you need to get all your pre-FOFA ongoing fee paying clients to consent before the end of the year. So it's something that we need to start working through. The next part is ending grandfather conflicted remuneration. Now this one is a little bit different because it's already law. So this one received royal assent last October. So we have until the 1st of January 2021 for any of the grandfathering conflicted rem to be received. Anything after that, it will now be considered conflicted rem. So what is that? The arrangements are already starting to be switched off. You may already be seeing that with the product providers. Many of them are coming out, letting people know when they're switching off their trailing commission or their volume-based benefits and things like that. So these are the types of benefits that will be switching off: investment trail commission, volume-based benefits and rebates, volume-based shelf space fees, and asset-based fees on borrowed funds. Some people were thinking, well, hang on, I thought they were banned. They are for new clients, but if they were entered into before 2013, the asset-based fees on the borrowed amounts was allowable to continue, but just not on the increases. So it's something to look out for if you have any geared clients. Any amounts that are received after the 1st of January must be rebated to the client, and you'll be in breach if you receive it. The complexity with ending grandfathered conflicted REM is that it's difficult to manage your cash flow, as it's unknown when the providers will start to switch off the arrangements. Just because it goes until the 1st of January doesn't mean that they're all going to wait until December to turn it off. We'll expect to see product providers switching them off this month, next month, as the months go on. It can be potentially difficult in identifying trailing commission through revenue types. So you need to make sure that you really understand which clients are trailing commission clients and which ones are ongoing fee paying clients. I'm sure you're across that with your FDS and opt-in arrangements, but it's worth having another look. It's unsure if all product providers will discount fees to clients. So it's making sure that you understand how each product provider is going to deal with the trail commission. Are they going to rebate it back to the client? Is the client going to have that money back in their account so then you can charge a similar fee? How does that fee work? That's something you'll have to look at. Commissions may be more significant than a client would be willing to pay in fees. So you may find there may be the occasional client where the commissions are substantial, but the fee comparison may be less. So that's probably something you need to work out and make sure that the fees that you are going to charge the client is commensurate with the services that you're providing to that client. On the flip side, you might also have clients that the commission is very low and you need to charge a higher fee. So you may have those instances as well. Consider if you're receiving any sort of grandfathered insurance volume bonus programs or any other sort of grandfathered programs, and consider whether you wish to stay as a servicing advisor where no commissions or fees are applicable. It may be worthwhile keeping clients on your books as a servicing advisor with no fee or no commission applicable, because they may need advice or service from you in a future date, and then you can actually charge them a fee for that at that time if they actually request service. But it's up to each advisor what you want to do. So polling question number 3, Jess, we'll open that one. Is it likely that ending grandfathered conflicted remuneration will be postponed due to COVID-19? Now, I didn't actually give you the answer to this, so you have to provide me with the answer. A, yes, B, no, or C, not sure.
All right, we'll close this one off now and I'll just share the responses.
Yeah, so 87% of you said no, and that is most likely the case. As I said, it's already law. Would find it extremely rare that the government would go back and change a law that they've already passed. They're already under the pump with everything else that's going on. So we expect that this will continue as is legislated, and that these grandfather conflict remunerations will continue to drop off along the way until the 1st of January next year. So in summary, this is what the proposed timeline of all the changes are, and I'll let you look at that yourselves. The big thing to look at here is that you have got that transitional period for your pre-FOFA clients, as I spoke about before, where you need to gain consent. Now that may actually move from where it is starting 1 July 2020 this year. Maybe it gets moved to starting 1 January 2021, or maybe, who knows, they might push it out a whole year, or they may still keep it as is but extend the transition period. We don't know how that is going to work, but we do know that those pre-FOFA clients will need to become annual opt-in clients. You'll see all the other things where they're commencing. So the no deducting fees from My Super accounts will start in July as well. So keep an eye on that one if you have got some My Super accounts. And I think the other part is ensuring that you're looking at your trailing commission clients as well, and what are you going to do with those? How are you re-engaging with them, and in consideration with what's going on at the moment with COVID-19 as well. So next steps, what would suggest that you do along with, obviously keeping your business running through this time, but it's to identify potential revenue at risk. And the two parts is that pre-FO for ongoing fee arrangements and your investment trail or commission. Need to make a plan to re-engage, and I would recommend that you speak to your business consultant to assist you in relation to this, but consider prioritization strategies. Who are you going to talk to first? How are you going to start to re-engage those clients? And then also making sure that you really look at your service and fee proposition to make sure that you are charging the appropriate fee for the services that you're providing to the client, because you may find that you are actually not charging some clients enough, and maybe you're actually receiving more commission on clients that you're not providing as much service to. Opportunities, it's always good to look at opportunities. There is opportunity for those trailing commission clients, particularly where there may be more suitable products, or what we call contemporary products, that may suit their needs, and it may be suitable to discuss that with the client and provide further advice. And as I said before, making sure your fees are commensurate. So there could be the opportunity where you assess a client and go, oh, I've only been charging them $500 a year. I'm providing them with $2,000 worth of service. I need to reconsider what we charge that client. And as always, stay positive. With the right plan, you will succeed. Make sure you ask others for help. See how they're tackling these issues, and never forget how far you've come. I know many of you have been in industry as long as I have, or longer. We've been through FSR, we've been through the GFC. We've gone through FOFA. This is another thing that we will get through. We just have to stay positive and keep moving forward and utilize that plan. And finally, I'm just going to whiz through a case study. Sorry, I have gone a bit quick today, guys. I hope you're getting all this. But this is actually an example of a what I'd call a mature practice. It's slightly tweaked, but it is an actual practice within our network, and it shows that their split of revenue is about 160,000 for ongoing advice fees, about 40,000 of investment trail, with 97 clients in one and 90 clients in the other. You can see the breakdown of ongoing fee by revenue, and you can see that there's quite a bit in this $1,000 to $5,000 range of 50, and 5 in that $5,000 to $10,000 range. And in the trail commission, it's a little bit less. It's got that 15 here of the 1 to 5, but a lot more in these lower amounts here. And you can also see that the product split is really between these two products at the higher level, and then a lot more of a mix as you go down. So my question is, how would you prioritize your plan? Where would you start? Who would you start to engage with first to ensure that these clients are on ongoing fee arrangements and they have consented in the required timeframe with the legislation? So I'll open up the last question, Jess. Polling question 4. How would you prioritise your plan? Would you engage with your trail commission clients first, commencing from the largest to smallest revenue? Would you prioritise based on products with highest revenue? Would you engage with your ongoing fee clients first, commencing largest to smallest revenue? Or are you unsure and you need more information from what I've given you before?
All right, so we're at 80% with this one, so I'll close it off and share the responses.
Okay, so the responses here is majority have said engage with trail commission clients first, and then some have said that they'll go with the ongoing fee clients, and then there's the other ones with unsure or need more information. And there is no right answer to this one. This will come down to your own client base, because you'll know your clients, you'll know who you can engage with, you'll know how engaged you are with your commission clients, and to know when to engage with them on this journey. But what you might want to consider some further data requirements, because the slide I had before didn't really break down the ongoing fee revenue to the pre-FOFA clients and post-FOFA clients. And what we've found when we've gone and delved into the revenue but per client and from a practice level, is that you may actually find some clients are in both buckets. They're not just a fee-paying client, and they're not just an investment trail client, or they're not just an insurance commission client. So you'll have clients with a mix of products and a mix of commissions and fees. You'll need to identify those trail commission clients and the pre-FOFA clients. And you might also want to identify super versus non-super, because if you have some clients with a mix of commission and fees across multiple products, you need to make sure that if you are charging a fee and it's related to superannuation or non-superannuation, you cannot charge your non-superannuation fees within superannuation. So there's a number of things you need to look at there, and it will really be delving into that level of detail at a client level. You also want to get a breakdown of your trail commission by product. So the reason we say that is it's probably best to engage with providers early to understand the process. How does it work? Are they rebating it to the client? Because that will give you an understanding of, if the commission was $2,000 and it's rebated to the client for $2,000, then you're more likely to be able to charge a fee without it impacting as much onto the client as previous. But if they don't rebate it and you're going to charge a client $2,000 and they don't get any benefit, then it's going to be harder to engage and explain that to the client. Also, you should be looking at your low commission clients. How are you going to engage with them? How are you going to make sure that you can explain your service proposition and what your fees are? Or are you not going to engage with them at all? Are you just going to focus on your higher clients first, and then if you get time, you go to those ones after? So there's lots of different things to consider. One major thing that you should be looking at is mapping of revenue data. Mapping of revenue data means that you map it to a client level in your software. So we use Compass primarily at Centrepoint. So it's mapping that data across and making sure that you can actually pull all this information at a client level or at an entity level. And you need to do your cost to serve analysis. Does the fee cover the services provided? And you need to consider, do you want to charge asset-based fees versus flat fees going forward? So in summary, covered a lot today. So basically, we want to ensure that you keep up to date with regulator responses to COVID-19. We'll keep you updated on Centrepoint Connect and in our newsletter, but we recommend that you have a look at their own links as well. Draft legislation may be delayed, but be prepared for it. So even though it's going to be delayed, don't be complacent. Make sure that you're getting yourself ready for when it does come through. Be aware about your pre-FOFA ongoing fee-paying clients, and that you will need to get consent prior to 31st of December 2020 if it gets pushed through as the current draft legislation states. Make sure that you know that you have to continue your normal ongoing fee arrangements with your post-FOFA clients and get them opting in, and it will be on an annual basis going forward, and that they'll need to opt in by the 1st of July 2021. Trailing commission will be switched off between now and the 31st of December. So we believe that that will continue, and that won't change. So you should consider your re-engagement strategies. Identify and understand the revenue impact to your business and make a plan. And you should commence or confirm mapping of your clients to ensure that you can work through the consent forms, get the right information on them, and enable this process to proceed as easily as possible. So that is it from me. If you have queries, profstandards@cpal.com.au, and I know there's probably some questions, but Jess, we're probably out of time, I would assume.
Yeah, there is a lot of questions, which is great. So we will get back to everyone individually, or we might do put together a Q&A as well if there's any great questions that need to be circulated to all attendees. So Tara, thank you so much for your expertise, and thank you to all those who joined us again for this session. Our next webinar, Market Update by Richard Quinn, will be starting in 15 minutes. Thank you so much.
Thank you. Bye.
Bye.